Saudi Aramco's first quarter free cash flow has fallen to a dividend coverage ratio of just 0.85%. This means not only a massive fiscal deficit for Saudi Arabia, but also signals that Middle Eastern sovereign wealth funds may sell global liquid assets to fill the gap. This will directly impact global asset pricing and your investment decisions. This is geopolitics and economy. The content of this video represents only personal views and does not constitute any investment advice. The market carries risks. Invest with caution. Let's start with the first core issue. Global equity assets are undergoing an unprecedented oligopolization. Many expect a broad rally in emerging markets, but in reality, capital is concentrating at breakneck speed into a few AI hardware monopoly giants. For instance, South Korea's stock market total market cap surged 86% in just 1 year to $5 trillion, historically overtaking India. Behind this, Samsung Electronics and SK Hynix, with their absolute monopoly in HBM high bandwidth memory and advanced packaging, both hit market caps over $1 trillion. Their explosive growth drove the entire South Korean market. In other words, global liquidity is pouring with unprecedented intensity into a very few companies with AI hardware monopolies. So for emerging markets and traditional industrial nations lacking these key supply chains, they face a severe long-term capital drainage effect. This extreme oligopolization significantly increases macro fragility in global stock markets and means investment risks are concentrating in unprecedented ways. The second core issue is Europe's core industrial system is undergoing a stagflationary disintegration. Many think Europe's economy is just slowing down, but it has already crossed an irreversible tipping point. Latest data shows France's May services PMI crashed to 42.9, the worst since the full COVID lockdown in 2020. This means persistently high energy costs and malignant inflation have severely destroyed French consumer disposable income and business confidence. Meanwhile, Germany's 20-year bond yield quickly climbed to 3.82%, hitting the highest since the 2023 Euro debt crisis, signaling high rates are draining real economy liquidity. The deeper issue is that the European Central Bank, facing a classic stagflation trap globally, is forced to maintain or even raise rates. This serious divergence between monetary policy and economic fundamentals is pushing core European economies to the brink of deep recession, fundamentally undermining the euro's long-term purchasing power. In my view, this is an accelerated manifestation of Europe's deindustrialization, and its impact will be long-term and far-reaching. The third core issue: global geopolitical conflicts are permanently resetting commodity price floors. Many think commodity prices are driven by supply and demand, but now, geopolitical security premiums have been permanently internalized into the global inflation base. The most typical example is the Middle East. Iran formally rejected the U.S. MOU proposal, and the Strait of Hormuz reopening is hopeless. This means 20% of global oil and gas shipping capacity faces permanent blockage. Saudi Aramco's first quarter free cash flow can't even cover its massive dividends, with the dividend coverage ratio falling to 0.85, forcing Aramco to use cash reserves or borrow to prop up the government, signaling an extreme rupture in the petrodollar internal cycle. Also, the U.S. is abusing Section 301 against Brazil, proposing a 25% punitive tariff, breaking traditional global agricultural trade routes and forcing Brazil's huge commodity volumes to shift to other markets. These events show the traditional OPEC output adjustment mechanism and WTO multilateral trade system have effectively failed. Going forward, any geopolitical tremor could directly and quickly push up commodity price centers. The fourth issue let's discuss. AI computing hardware has fully moved from the expectation hype phase into a capacity crunch phase. NVIDIA launched the RTX Spar chip at Computex and announced Vera Rubin production, marking AI computing expanding to PC and next-gen data center architectures. But more critically, the real physical bottleneck in computing networks is now data transmission speed. 1.6T Ethernet optical modules have officially entered mass delivery. What does this mean? Upstream silicon photonic chips, optical components, and high-quality fiber capacity are being locked up by overseas tech giants through multi-year long-term contracts. In the past, the market debated AI's future potential. Now, we see top players frantically competing for core capacity. In my view, China's optical communication supply chain, with its irreplaceable global division of labor in packaging yield and manufacturing scale barriers, will substantively usher in a Davis double play of rising volume and price. The certainty of earnings delivery for related core assets is extremely high, but capacity bottlenecks will become increasingly evident. The fifth core issue is copper is facing a long-term structural absolute shortage. Many think copper price rises are cyclical, but in reality, the global copper market is breaking away from traditional macroeconomic cycles, showing strong, independent upward momentum. On one hand, global AI data center power grids and new energy exports are consuming far more copper than expected. On the other, U.S. refined copper imports have surged beyond expectations, leading to an absolute shortage of 64 million tons in non-U.S. markets. Combined with irreversible grade decline in traditional Latin American mines and a decade of underinvestment in capex, the green computing premium for copper prices has become consensus. This means the copper price center faces a new leap, and industrial metals are beginning a long-term structural bull market. For Chinese mining giants with overseas high-quality mine assets, like Zijin Mining, they are entering a long profit expansion cycle. This is a profound reshaping of the global resource landscape, with ongoing impacts on industrial production and downstream costs. Finally, let's look at the sixth issue. The aviation and logistics industries are becoming direct victims of geopolitical black swans. The Middle East crisis has effectively blockaded the Strait of Hormuz, sending international jet fuel prices soaring to an extreme range of $150 to $200 per barrel. This directly hits the aviation industry's weak spot. Fuel costs typically account for over 30% of Chinese airlines' total operating costs. To cope with cost pressure, Air China, China Southern, and China Eastern have been forced to sharply raise domestic fuel surcharges, up to 120 yuan. This cost-passing behavior will severely hurt the already price-sensitive summer tourism and travel demand. Morgan Stanley has urgently cut target prices for Air China and China Southern, and expects China Southern to face a huge loss of 5.9 billion yuan by 2026. The post-pandemic recovery in aviation has been completely disrupted by geopolitics. Meanwhile, very large crude carriers are forced to detour around the Cape of Good Hope. After short-term capacity dislocation, in the long run, they will face a fatal blow from cargo shrinkage due to a substantial real drop in crude export from countries like Saudi Arabia.